there's still a lot of money in this country. You're probably going to see more of it move into vehicles outside the traditional banking type framework, such as venture capital funds and private equity funds, and the creation of things like what's called a special purpose acquisition company, where you raise money from very wealthy investors and use it to purchase an existing company and take it over. So these are financial institutions that are done without the banks or without formal intermediaries. So at one level, you might actually see more money going into things like venture capital funds and more what economists call disintermediation. That is, the bank or the formal financial institution is an intermediary between the people with money who want to invest in things and the people with demand for money who want to start a company or something. So I think, ironically, that's one area where more money is going to go into. So the question is, what provisions, if any, are in the new legislation that will ensure that money is lent to Main Street? So I'm sure none of us have actually read the legislation, but that never stopped an economist from giving an answer. Seems how Robert's actually working with that.
Well, I mean, the logic is that as I think Michael's presentation was excellent on the Paulson-Bernanke plan, and if you set the suppose you don't do the auction and say, okay, the hold to maturity price of these, like these are mortgage-backed securities, and there's a maturity date on it, like any bond, right? So if the maturity date is 3 years from now, the Fed, the U.S. Treasury would hold these bonds until 3 years. So say that price is 100 and the fire sale price is 20. They may know that that price is 100. So suppose they give them 95, a huge subsidy, right? Huge kind of, that's cash to these banks. The idea is that they can, mark their securities, whatever other securities they have, these asset-backed securities at 95. And they could put that cash in their capital, so they have more capital, and there's less worry among banks that there's more information among banks, more transparency. They would know their balance sheet structure much better. So this short-term interbank lending market is going to function a lot better. They would lend more freely to each other, so the banks would have more money. And then that would mean that they would be more willing to lend to non-bank corporations. And that's the logic. That's the logic of this. So we'll see if it works. And I think it would.
So I think the logic of it, as Robert pointed out, is banks lend each other money, and then they lend it to us or to Main Street at a higher rate than it costs them money, and they make a profit on the difference. And the market where they set the cost of funds, what's the cost of money to a bank? Well, they can get it from the Fed, that's the Fed rate, but mostly they get it from this market, the LIBOR, the London interbank rate. And as Bob mentioned previously, the traditional historical gap between the federal rate and the LIBOR rate was 1/4 of a percentage point, or 25 basis points. And lately that went up to 425 basis points, or 4.25%. So in other words, if the federal funds rate was 2%, it costs banks 2.25% historically to get money, and then they would lend that to me at 5% and make a profit. Now, at 4.25% premium, it's costing them 6.25% to get $1. So they're going to have to lend it at a very high interest rate. And in addition, there's more risk that I'm going to default. So the interest rate at which they're willing to make a loan to Main Street is very high, or if at all. If they think there's no market there, they're not going to bother to even try and borrow the money. So the hope is, by getting that premium back down to 1/4 of a percentage point from 4.25, that the market will be re-energized and they'll start lending again, because there's enough room there to make a profit.
The house price appreciation, although the timing is not exactly the same, also occurred in Europe as well. And so the reasons for them talking about a bailout are very similar to the reasons why it's happening in the US. But specifically about the European bailout, I don't know any details about it, but it's the same idea. So a lot of analogies can be made, I think.
Also, banks hold some of these European banks also have the same sort of asset-backed securities and other derivative contracts that are linked to that, as American banks. Yeah. They have American banks.
Yeah. So these assets that were created by bundling together a large amount of US mortgages, and then you create a new asset, which is perhaps 1,000, the right to get the income from 1,000 mortgages. That was the process of securitization that was mentioned. You create a new security. They were sold globally. And so probably the majority of them actually held outside the country. I think you have to worry about the level of concentration and competition. One economic lesson that's sort of been forgotten in all this is antitrust and competition policy is still important, and the fact that you've got a crisis means you shouldn't forget about them and allow mergers and transactions that down the road are going to eviscerate competition. There hasn't been any discussion of this at all, but you're right. So the large investment banks, there was only a few of them, but they controlled the large financial transactions. For instance, if you were General Motors and wanted to issue $10 billion of bonds, you shopped it around to see who would give you the best price. Now you've got fewer people to shop it around to.
Should the legislation try to break them up into smaller banks?
Simon said it very clearly, but one thing that's interesting is that these are ongoing processes, and there's a wonderful Bruegel picture which I didn't show you, which is called Big Fish Eat Little Fish. And that's basically what's been going on. The big fish that have eaten a lot of fish lately happened to have been the ones that almost accidentally had been a little bit more conservative. And banks are things that have very large sums of money available at appropriate moments. And it's the lucky ones in this case which were able to eat a large number of fish. So they're quite exhausted at the moment. But from the point of view of competition, it's extremely bad news. You don't want very large players because, as Rob pointed out, moral hazard is one of the worst things that you have that pervades the financial system. And when banks get very, very large, they know that nobody can possibly let them go if something goes very wrong. So it's liable to lead them to become not only monopolistic for all the standard reasons, but also to make large, reckless bets, which can lead to a lot of trouble. So I think it's something to worry about a great deal.
Has the Fed purchased any mortgage-backed securities, and if so, how does that affect the value of the dollar?
I think that's
I mean, I think the Federal Reserve lending requires collateral, and they expanded their definition of what is appropriate collateral. And I don't know for sure, but I think it does now include mortgage-backed securities. But I have to check. So if that's the case, they're not selling it to the Fed, right? They're using these things as collateral, and that's a very different matter because they need to pay back the Fed for their borrowing. The Fed doesn't give you grants. It gives you loans, and it gives you loans on collateral. And so they're expanding their definition of collateral, and it may include these mortgage-backed securities. But eventually, the banks have to pay this back to the Federal. The Federal Reserve can't put its capital at risk. Only the Treasury can do that because the Fed is not it's sort of a mix between a private and a public institution, and so it can't really put taxpayers' capital at risk, money at risk. And what was the bottom line of your question?
What
Impact on the dollar. Well, if anything, I would have predicted the dollar was going to weaken, right, because of the potential inflationary. So that the dollar is strengthening is is a surprise. Is a surprise right now, and what people, I don't know. I think it could be a sign that there's greater faith in the U.S. stock market or U.S. economy going forward relative to Europe and Japan. Europe is going into Europe's going to have negative growth too, and maybe even worse than the United States, because their central bank is very focused on targeting the inflation rate and not the unemployment rate. So they've been very tight with money, unlike our Federal Reserve. And so usually that results in a weakening of the U.S. dollar. But in this case, since probably people expect the European economies and the Japanese economy to decline even more rapidly than the United States. So I think that's could be what's going on.
I guess I have a two-part question. Is the U.S. are U.S. financial markets still like big players in the financial world, given the existence of like the Middle East and other markets like that? And even if they still are, is there a risk, or should we call it a risk, that while the U.S. is kind of on its downward trajectory, those other markets will develop and maybe overtake some of the opportunities that we've enjoyed?
Well, you have to worry about different countries. The US at the moment is roughly 1/2 of the world's stock market, 1/2 of the world's bond market. And so that's why when things go wrong in the US, they have enormous consequences for all the other participants in the world. The next largest country in terms of financial markets, stock market, is Japan, and that's probably 1/5 the size of the US. Your other question had to do with what's going to be happening in the future. I think one of the extraordinary phenomena that's occurring right now, and we have a lot of Asian students here, is what's happening in China. And I think everybody knows that the events in China are going to, in the next 20 years, cast a very large shadow on the United States. That's to say, I think those markets are going to grow enormously fast. The players, so if Japan is now 1/5 of that of the US, I think you'll find that the Chinese will catch up very fast. And so they're going to become extremely large players, and the equation is going to change in very fundamental ways. The last time I looked at the data, you have to understand that these are, you're talking about stock markets. Give me a Middle Eastern country that first of all has a decent GNP. Look, so this is in-house stuff. It's a joke. There's none that has a serious stock market, right? And you're talking about the two big financial markets, the stock market and the bond market. So once they earn a lot of money on selling oil, that doesn't mean they have any fundamental economic activity that's at all on a par with countries like the US or the Europeans or Japanese, right? So from that point of view, you should just say, well, that's a joke. That's the only way you can describe it. Not a very funny joke, because we should be using orange juice to run our cars or something like that we could get plenty of from Florida. So we need to basically try to forget oil, and if you do that, then all those countries are just so many sort of bits of paper that you can forget completely.
Talking to people, that investment banking is a wildly popular choice for business students and econ students graduating now. Based on the recent events, would you counsel them to reconsider their career path? And if so, where would you put econ skills?
Oh, that's a great question. Look, I mean, if you've looked at what's been happening to the big investment banks, the short and long of it is that because of the way they were able to, handle their leverage ratios, these guys did in the last 15 years, they just made a ton of money. The game is over. It's finished. There's a new game that's going to have to be played. So if you want to get into investment banking, don't think that things are going to be like they have been for the last 15 years. That game is over. And I'm not sure which sector I recommend that you go into, but don't go into that one.
Real estate, that's
one thing you might want to consider is actually bankruptcy litigation. That's a huge growth industry. We're approaching 2 o'clock. We're willing to stay on a while longer if there's more, but just to give people a heads up if they have to run to class. Down the back.
I've read a lot of press about the idea of mandating like active, and then there's called a party trust, and so cause all these financial. And what I want to know is that for the economists, what are the mechanisms that cause this kind of practice in relation to the connected thing called a party trust? The second thing, how would the bill in any way resolve that problem?
Okay. So there was a bit of noise there, so I'm going to translate the question. So the question was, there's been some discussion that the fundamental failure is the failure of trust in the marketplace, and how would the bailout solve the package? Bailout package solves the trust problem. Does anybody want to start with that?
Well, as we mentioned, part of the lack of trust is that we don't know what the asset side of the financial institutions are, and by setting a price on these mortgage-backed securities, that'll resolve some of that uncertainty. It'll make it clear, and I think that's right. So there is really a lack of trust, and the financial system can't operate. It's an intertemporal thing. If you lend, you expect to be paid back, and if you don't trust somebody, you're not going to lend to them. That's why drug dealers always deal in cash, not loans, right? So I agree that needs, but this is one way of doing it. Recapitalization is another, and probably some of that has to be done in the future if this current bailout package doesn't work. But there's plenty of ammunition.
By the way, the question is interesting because I think one of the interesting things about this recent phenomenon, every American wakes up and listens to the news, and the first item on the news is what's happened to the Dow Jones or the S&P index. And so they're completely used to the idea of looking at the stock market. The real change with this one is that they're looking at the bond market. Now, the interesting part about this is that in a certain sense the bond market is far more important. Those who take courses in the business school will know that this area is called fixed income securities. Well, it's not fixed, and it may not be income, and I don't know what kind of security you call it. But the really interesting conceptual part of this story is that America is waking up to the importance of promises. The bond sector is one big promise into the future, and real activity can only be supported by these conceptual bridges into the future which depend on confidence. And so the reason that somebody like Paulson, the reason that somebody like Bernanke, who's extremely smart, a very, very perceptive economist, realized that this crisis is different. Look, in 1987, the stock market dropped 20%, and it didn't matter a damn. All it meant was that a lot of these people had been grinding away on their computers, and they all worked together and dropped the stock market by 20%, but there were no real fundamental consequences. If the bond market were to take a similar smash, and they're working at it, they're doing a pretty good job, it'll decimate confidence and funding of real business, and so it's not a laughing matter at all.
Down the back.
A few months ago, people were talking about inflation, but now there's a talk of deflation. Is that
I think, yeah, so people were talking about, at the moment, what's called deflation in the price of the assets, like housing prices. So now we're sort of stuck in we were worried about deflation. Now we've actually got CPI inflation because the Fed's been pumping so much money into the system, and at the same time commodity prices are rising. But we've got deflation of asset values is what's going on. So I don't know if that combination has a name.
Yeah, I don't think you're going to see CPI price deflation with an American central bank. They've been very good at pumping liquidity, unlike in Japan where interest rates were not cut. So, if anything, I worry about inflation and slow growth. Back to the 70s, I worry a little bit about that.
So the players in this bailout think there's basically two prices to the same asset, so-called hold to maturity price and fire sale price. Robert already talked about those. So if you hold on to that asset for many, many years, you're going to get $1. But if you want to sell it immediately right now, you're only going to get 20 cents. So if the Fed buys it at a price between those two and holds it forever, for a long time, the expectation is it's going to get something closer to the one. But yeah, but it's, you know, there's not everything is very clear in that logic, I have to say.
At one level, I think it depends which assets they buy. So if they buy something like the original pools of mortgages and just hold them, we'll probably do okay. But if they buy some of these derivatives, the swaps, they're never coming back. That's burned money.
I'll answer briefly. Look, it's already a fact. I mean, Fannie Mae and Freddie have what, 80% of U.S. mortgages, so they're now government. Yes, there's, you know, in America, the Congress has always wanted very high ownership rates of housing, and so Fannie and Freddie date back to what, the late middle 68 and 70 respectively. And they were institutions whose fundamental objective was to make housing accessible to very large numbers of people. That means issuing mortgages. And so, yes, in America you've got this strange thing. It's a land of capitalism, but where the biggest single capital item that a person buys is actually brokered by the government. Now, that's not necessarily a bad thing.
Timing, you know, who knows, right? But hopefully, if it's, as Michael and we've been saying, if it's based on confidence and trust, and if that returns, the spreads have already declined. Like yesterday was, the LIBOR was, you know, spread of like 427, and today it was 200. So like already there's been a 200 basis point improvement in LIBOR, right, in just one day. So this could go real quick. As long as confidence returns. The Japanese savings rate that's always been high, and if anything, it's fallen because of the demographics. And yeah, I think consumption's down because people are generally uncertain about the economy, right? I don't think it has much to do with the financial sector. If anything, now that the United States is going into recession and consumption tanks, and if people could build up their savings, that would be a great thing. U.S. can't continue to run these $900 billion current account deficits every year, right? Again, so that's because of low savings, and if this can help raise a saving rate, that would just be fantastic. With regards to the regulation issue, you know, I was against the repeal of basically the repeal of Glass-Steagall, which separated the investment banking, the securities, the kind of trading and marketing of securities, both bonds and stocks, by commercial banks. But now they could do both, and so I don't know if we're ever going to go back to that. But I'm even for increase government ownership of these financial institutions, and there's some provisions in the bailout plan that allow for that. The government's going to be, and to exert more control, at least over the too big to fail commercial banks over the next few years, because you can't bail them out on the bottom end and let them do whatever they want on the top end. You've got to chop off the top end by regulating them. I think that's what Michael meant.
I think one thing you're going to see, obviously, is Michael talked about leverage. So a regular bank has to keep a certain amount of liquidity, cash and other assets that are deemed liquid, and I believe it's 8%. So if I have $100 in assets, I need $8 in cash in here. And these institutions that were deregulated or unregulated, so were allowed to go up to, ratios, leverage of 30%, 40%. So Fannie and Freddie were allowed to go from 8% to 2.5%, which meant essentially a 40% leverage ratio. So the first thing I think you're going to see is regulation of allowable leverage ratios and caps on that. That's probably pretty reasonable and not too intrusive. Getting back to the first question, I think there's still a stock ticker, but pretty much the private equity in Fannie and Freddie's been wiped out, and pretty much the government owns what's left of them. So they are pretty much government-owned entities at this point in time. There's still a public stock, but the government will have the claim on all of the capital. Vis-a-vis mortgages, there's one, and issuing the mortgages at a different rate. We might see more of that for purely a mechanistic legal reason. So when these asset-backed securities were issued, so I took 1,000 mortgages and put them into a new security, those securities were then sliced and diced and resold. So how does that work? You actually form a trust, and then the bank or somebody would act as trustee for the security. And so if you wanted to do something to change the value of the asset, you actually needed a vote. You actually needed a 2/3 majority of the people who held the shares in the derivative the securitized asset to say, work out, let's revalue the mortgages. Now that the government holds them, they can do that automatically because it's one guy rather than 100 guys. So you probably will see more revaluing of the mortgages.
Just on a conceptual sort of issue raised by these things, we've said that when we were talking about both bonds and stocks, these are long-lived assets. Any long-lived asset has a stream of payments in the future, and if you like, you can chop that stream into two parts: the part that you might get during the time that you hold it, plus what the capital value is at the end. And fundamentally, the value of an asset for somebody is what it's worth to you during the time that you hold it, plus what you can sell it for at the end. And the fragile part of financial markets arises from the fact that you put a lot of weight on what you think you can sell this thing for at the end. And this is really what bubbles are about. And why is this related to the business of the government owning a part of things on the stock market and things on the bond market? Well, if you want to influence and perhaps prick bubbles, then the chances are that you're going to have stocks of them that you own. And so one of the very new and interesting aspects of this whole financial crisis, I think, is that the traditional role of the government in an economy, which has been largely confined, if you like, to monetary policy, is now really being opened into a much bigger arena. Possible participation in the stock market and extended participation in the bond market.
So on that thought, I think we'll close and thank everybody for coming.